Hi, you're watching ET Markets live stream, your go-to source for insights on stock markets, trading strategies, and much more. I'm your host, Neha Vashisht Mahajan, and in today's episode, we are going to talk about how to trade safe and manage risk in stock markets. To discuss more on this, we have Mr. Aamar Deo, Senior VP, Research at Angel One Limited. Welcome and thank you so much for joining us today, Mr. Amar.
Yeah, very good morning, everyone, and thank you, Neha, for having me on the show.
Good morning. The pleasure is all mine. So let's quickly start our session. Let's start with how we should look at risk, what risk is, and why is risk management crucial when it comes to trading, especially when we're talking about volatile markets.
Yeah, I would say that if you really ask me in a single line, what exactly is risk management, I would
Mm,
say that's the line which separates the winners from the losers. So, because
right.
see, markets, one needs to be when one is in the market, be you a trader or an investor. You have to
Mm,
understand few things that there is no way around volatility. Markets will remain volatile. Some days would be extremely volatile. What we are seeing currently, some days
yeah.
there could be less of volatility, but volatility is there to stay in the markets. It has been there for ages and it's going to be there for ages. So there's no way around it. You can't wish volatility away. And risk management is what protects you during such volatile times. It also acts as a cushion, so it's like a safety net. It will help you protect
Mm,
your losses, because ultimately what happens is that there's a very nice saying that the first loss is the best loss, or you will take the mother of all losses. So if you define the loss or the risk before you initiate the trade, you are far ahead of majority of the traders or investors, because then you're not acting emotionally, you're acting more logically, you're acting more
right.
rationally. That's one. Secondly, what happens is that risk management gives you a window of clarity, because if you look at the markets are chaotic in nature. At many times you'll not understand what is happening. Like for example, if we look at the markets, the way they have corrected and they are correcting, sometimes it defies
Mm,
all laws of gravity, and markets are correcting significantly. So you're trying to find some sense, some reason, but many times we are not able to find a reason or attach the specific cause to the effect. So in that case, we get into a panic mode, or we get into a fear mode, which is never good when you are in the markets. So
mm,
so the point here is that if you have a risk management policy in place, if you have a money management policy in place, you will think clearly. You'll not be clouded by your emotions, because majority of the people, the traders or the investors, they are clouded by their emotions, and that is what is unfortunately the bane of their trading or investing. Because what
mm,
happens is that then they'll take small profits, but in one trade they'll take a huge loss. And ultimately it's like that. There are, just to make it even clear, there are two students. One studies all the day and gets say 60% mark, and the other is studying on and off and he's getting 80% mark. So net in the end, it is the result which matters. So if you're
right.
having proper risk management in place, the probability and possibility of you being hit very hard negatively in the market reduces a lot. So from that perspective, I would say it's what separates the winners from the losers. And there's another very nice saying which says that refusal to take risk can be
Mm.
riskier at times. So we need to understand risk, we need to define risk, and we need to act on that risk if we are to succeed in the markets.
Absolutely. So before we move to the next leg of our session, where we are going to discuss a lot of tools, a lot of features that help you manage risk. For example, market price protection, trailing stop loss, secure exit, and set exit. Let's also talk about the common mistakes that traders make when they're managing risk.
Yeah, so if you look at the common mistakes which traders make, so I'll list down few mistakes. One is that they believe that they have to stay in a trade as long as they don't make money in that trade, which is never a good idea. You have to
Hmm.
understand two things. Trades can go right, trades can go wrong. You should have a plan as to what you will do when the trade goes right, and what you will do when the trade goes wrong. So if you have that in place, you will think properly, you'll act properly. So some rules for investing, for trading is very much essential. That's one.
Hmm.
Secondly, if you are into the trading from a short term perspective, avoid averaging your trades. Like for example, if someone is trading into options and
mm,
you bought the option and the option price comes down, you are again averaging. That's never a good idea. In investing from a long term perspective, still that can be looked at, because if you're looking at some very quality names and you want to add on to them and prices, like for example, you take any name today, what I would say the top Nifty 50, majority of
mm,
them have witnessed correction anywhere between 20-30% more.
yeah.
So, and if you look at the mid cap, small cap, there it has been even a greater correction. So, what I'm trying to tell you is that if you are looking at investing from a very long term perspective, then maybe you can do a stock portfolio SIP and buying on significant corrections, but holding from a 3 to 5 year or maybe a 5 to 10 year perspective, then it makes sense. But if you are into a trading perspective from a very short term perspective, and if you're trying to average,
Mm,
that's never a good idea, because what we are seeing currently, the trend is down. Markets every day are making new lows. So
yeah.
or fresh lows of so it doesn't make much sense there. So again, there's a very nice saying that losers average losers.
Mm,
So if you are averaging your losing trade, is never a good idea, until unless you are looking at it from a very long term perspective, until unless you are an investor. If you are new trading, you should never, as far as possible, average your losses, because if you are from a trading from a very short term perspective, intraday, very short term perspective, it doesn't make sense. Rather, it makes sense to go with the flow, go with the trend, identify whether the bulls are strong or the bears are strong, and based on that, you
mm,
decide and look at the some of the macros or some of the sentiments. I'll not say macros, but more of the global sentiments for the day, domestic sentiments for the day. So
okay.
that would be more useful. So this is a second mistake that traders make, that they average the losing trade. That's one. The
Mm,
first is they don't have a plan as to what they will do when they are right or wrong. And third is never over leverage. Meaning
mm,
if you are driving a car, you know that driving at 60, 80, 100 also is okay. But if you are going speed and the car has a speed max speed of say 220, 240, doesn't mean that you have to make the speedometer touch 240, because
right.
ultimately it's your life at stake. So in the markets, it is your financial life at stake. It's your financial
Mm,
capital which is at stake. And I'd just like to explain it with one example. It'll make it very clear. Suppose
so,
someone goes into scuba diving. So we all know scuba diving,
mm,
you go deep in the ocean. What do you take along with yourself? You take an oxygen supply. But at the same time, you need to remember that if you're taking that oxygen supply with you, you also
mm,
have to come up to the surface. So you should have sufficient oxygen remaining, because otherwise you can go so deep, but by the time you
yeah,
come, the oxygen supply is over. So your risk management is what protects your oxygen supply, what protects your capital. So this is what
right.
I would recommend traders to, who are very serious, or investors, to look at it from that perspective. I hope that gives them that clarity.
Yeah, yeah, sure. And it also goes when it comes to driving also. You took an example of the high speed limits. So you should know when to, pause, when to apply the brake. So I think that is something that's very important when it comes to trading, because trading is very, very time sensitive, whether we're talking about short term or long term. So now let's talk about market price protection also. Before we understand how it helps in limiting losses, let's understand what exactly is market price protection. Can you explain it to our listeners?
Yeah, sure. Why not? So, see, what happens is that when we look at the markets or stocks, so you got large
Mm,
caps, you got mid caps, you got small caps, and you find that if you look at the volumes, so you'll find that maybe 200, 300, max 500 stocks would do would do more than 90% of the volumes. So rest of the stocks might not be having volumes on any certain specific day.
mm,
We might see volumes, but otherwise we won't see much volumes on that day. So market protection is basically a feature that helps traders during highly volatile markets or illiquid markets. So if you look at that feature
okay.
as to how it works, so market protection in that case, it'll help you that suppose for example, if you look at a particular stock, and for
Mm,
example, if you look at Zomato, and we
mm,
see as to how it is moving. So Zomato is fairly liquid, but if we have a stock which is not very liquid, but there is increase in volatility. So
Yeah.
sometimes you are looking at buying at the market, okay? So you're looking at buying at the market, but you are not able to, uh, because it is very illiquid, that stock is very illiquid or it's very volatile, it could jump. So, and you
Hmm.
could be, if you're buying say at say 220 XYZ stock,
Right.
and then automatically there is a spurt and it doesn't buy at 220, you're putting at the market, it goes at 224. So in that case
Hmm.
you are losing out. So this market market I would say this price protection helps you in that regard, that it will
Okay.
set an upper limit. So it will set an
Hmm.
upper limit as to where it should actually have. So if we can have the screen, I think that will be even better for viewers to understand, if we can,
Yeah.
look at that perspective. So because I'm explaining it, but if we have a visual
Hmm.
as well, that will be even better. So
Yeah.
looking at it from that perspective, it basically into to make it make your our viewers understand, it helps you make a market order as a limit order. So in that case, what happens is that if it is very illiquid, so you're not getting trapped. So there could be a certain percent.
Yeah. We have the screen. We
Yeah.
have the screen. Yeah. Yeah. Okay.
Yes. So if we look at this market price protection. So in
Hmm.
that case, what you see is that you limit as to what is there is a certain percentage limit, so which is predefined for cash and for your options. So beyond, so that becomes your limit. So in case the market is flying in any direction, you're not
Hmm.
getting trapped. So this is a very good feature, which I would say traders will more like it, because from an investing perspective it really wouldn't matter much, but from a trading perspective, when a 0.5% is a significant thing to look at. So this
Right.
market price protection can help traders. I would say that they should definitely explore this window, because this is for your intraday, this is for your options, and it can be very useful because I'll just to explain it in slight detail. The best of the best traders, investors in the world, they average close to anywhere, I would say on the higher side, 25-30% max
Hmm.
annualized
Hmm.
returns. I'm saying on the higher side. You take the best of the best traders. There are exceptions, very rare exceptions. One by the name of Jim Simmons, he passed away recently. He had
Hmm.
averaged almost 66% annualized returns over a 2-decade period. So that he's a outlier, you can say. But majority
Hmm.
of the best traders, including Warren Buffett, you name anyone, it's 20%, 30% on the higher side. So if I make it
Right.
on a monthly basis, a 30%, that becomes 2.5%. So on a weekly
Hmm.
basis, that becomes 0.6%. 0.6 into 4 is 2.5% a
Right.
week, a month. So 0.6% return a week. Now if we make it to a day, so that is roughly 0.1%. So if you're
Hmm.
buying only a stock where and you're trading intraday and it goes up by zero point 0.5 and you're missing that out, so how will you make that sort of money? So it becomes
Right.
very important and essential for traders to understand that even 0.5% during the day missing that out, that's a big, because 0.5% in one day is roughly
Yeah.
10% in a month. That is roughly around 120 or 135% annualized, which none of the traders worldwide ever make. So small things add up to big things. That's something which is there, and this market protection can help there. So hope our viewers got an understanding of that.
All right. So now it's time to look at another term that's quite known in the markets, which is trailing stop loss. So what exactly is trailing stop loss, and when is the best time for the traders to use it? Also, along with that, could you also explain how should traders decide when it comes to the right trailing percentage or value?
Yeah. So see, trailing stop loss is a very good thing to have, because generally what happens is that if you can pull up the trailing stop loss feature. So what happens here is that generally traders, when they are in profit, I have spoken, I speak this, I like this term very much, that
Mm.
when we are in profit, we become a trader, and when we are in loss, we become an investor. So
Right.
but if you can reverse this psychology, that when you are in profit, you become an investor, when you are in loss, you become a trader. Meaning what? You should know when to cut your loss, you should know when to ride your profits. So trailing
Mm.
stop loss is a feature which can help you ride a trend, whether you are a short-term trader, intraday trader. It can help you ride the trend, because sometimes you'll find that the stock isn't doing anything, market isn't doing anything, and then all of a sudden it has started moving and it's gone up. The stock goes up by 5%, 8%, 10%, whatever. Market also moves up very fast. Your option moves up very
Mm.
fast. So in that case, what trailing stop loss, and one more important thing you need to remember, I would say, that it's not that it's just like a game of cricket. If I were to take, you are a batsman and you have say for example 12 runs to score in an over, okay, and you got
Mm.
6 balls remaining. So it doesn't mean that every ball you have to hit it out of the stadium for a six. So even if you can make, even if you can, of the first ball, if you hit a six, so in the next 5 balls, you require only 6 runs. So even a one or two or a four here and a dot ball on here, that also is fine. So the point what I'm trying to tell you is that if you look at trading or investing, not all your investments, not all your trades will make you big money. No, it would be
Mm.
only 5 to 10% of your trades which will be able to make you big money. Rest all what will happen, you make some money, you lose some money. Most important two things you need to remember. One is that one is that you don't take a big loss, so where your money management comes in place. And secondly, can you ride your winning trade? So this trailing stop loss can help you there. So you can set it, you can first of all, for example, if we can pull up the screen once again for the trailing stop loss and see, we have, for example, we can pull up Zomato chart, or yeah, Zomato. If you can look at Zomato. So what we are seeing here is that currently it's around 220, 526. Now suppose someone wishes to buy
Mm.
Zomato. So you had a question, Neha, as to what should be the percent or what should be the value, kya rakhna chahiye,
Yeah.
kaise rakhna chahiye, what is it that we need to do. So what happens here is that you see that price is at around 224, 225, and the person who's trading sees that below 220 is a very technical, very good stop loss. So you have a stop loss
Mm.
there, and you put a trail stop loss. So say you're trading intraday. So even a 1% move is a significant move. So what you can do today is an
Right.
exceptional day where we are seeing a lot of movement there. But otherwise, if you look at movement is comparatively less. Uh, uh, so what happens here is if you say that okay, 1% of 220 or 224 is roughly around 2.2. So I'll put a trailing stop loss at 2. So the moment
Mm.
it starts moving in your direction, because you have to understand that now this again I'll explain with an example. Let this be here. You generally find that there are roads which are two-way, and then there is a one-way road. You can go only in one
Mm.
direction. So the trailing stop loss is also a one-way road. It can go only in your favorable direction. So if the market starts, for example, you buy the stock and it starts going up, 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 and up, so your trailing stop
Mm.
loss will also keep moving. So this I want all the people who are viewing this, they need to understand that you don't have to hit a six on every ball. You need to protect. Some balls will go dot. You'll not be able. You have to protect your wicket also, because if your wicket is gone, that means your risk capital is wiped out. So risk
Right.
management can help you. And trailing stop loss at times can help you ride the wave, ride the trend, be it intraday or otherwise. So it's a very good feature to have. It can be set up in your definitive terms, but it's better that you look at the stock, see what percentage of move it makes, and based on that, you keep a definite number. So hope that helps.
Absolutely. So, the next thing we should discuss, I think, is the set exit and regular stop loss. A lot of people get confused between these two. So, what is the main difference between set exit? What exactly is set exit in a very simpler manner? And then, how is it different from a regular stop loss?
So basically, what happens that if you have a, I'll just make it very clear and understand. So set exit is wherein it's more of a automated sort of feature, wherein once you define your stop loss and your target in a single interface. So if you can pull up the chart there, So
Hmm.
we can look at that. So we can look at the screen and explain. So what happens here is in set exit. So if we look at, you are actually uh, having the opportunity to both set your profit, your target, and your stop loss. And when you go into, so if you look at, so you can, here you can set both in terms of your stop
Hmm.
loss, in terms of percentage. That is something you can do. So if you say that you
Okay.
want a 1% stop loss and a 2% target, or you can
Hmm.
also specify in quantity terms, and then you place the order. So once the order gets placed, so what happens in that case? You will see that you go to your open positions. You can go to your positions which are there, and in that
Hmm.
case you will see that you have this facility wherein you are having both your target and stop loss, you can see. Now in this case, what happens is that if either of that is executed, so if your target gets achieved, okay, your stop loss automatically gets cancelled. So
Okay.
what happens here is that in case of you asked a question as to stop loss and this set exit. So in set exit, it's
Hmm.
more of an auto and cancel. So it helps you there. One cancels the other, the OCO.
Okay.
Wherein in stop loss, your stop loss gets triggered, but you don't have an opportunity of in that case setting your profit, your target price. So this is a
Hmm.
very good feature to have. It basically eliminates any sort of manual intervention. It saves time, it reduces stress, it also reduces your screen time. Now for example, you're looking at a particular stock and you say, okay, I want to really put a stop loss here. I can put it for so you can have it for your intraday, you can have it for your
Hmm.
options also, you can put, and then you can leave it. You can leave it and then forget it. So once the one leg gets executed, the other gets automatically cancelled. So this is a good feature to have, and it's a single percentage. You can choose your predefined percentage options. You can manage your risk directly from your position books. So this is a very
Okay.
good feature, can help traders, active traders, to do other things also at the same time, and not look at the screen all the time, because looking at the screen all the time is also quite stressful if you have a big position and if the market is not going in
Right.
your favor. But at the same time, if the
Right.
market is in your favor, then you have smiles all the way. So but yeah.
Definitely. Okay, so the next and last feature that I want to talk about is that is something very common when it comes to safeguarding capital, and which is the most important thing for a trader, secure exit. So, what exactly is secure exit, and how can it help traders safeguard their capital easily?
Yeah, so I would say this is an excellent feature. I would definitely recommend those who are into active trading to explore this feature, because what happens is that I'll just explain and then we can have the screen. Generally, what
Mm.
happens is that those, see, you got different types of traders. So there are traders who will say, okay, I have one open position. Once I square
Mm.
off this position, then I will take the next trade. But there are many traders who will have multiple positions. So they'll have multiple positions, and it could be that they are trading futures, they are trading options, they could be stocks, they could be trading many things, many types of
Mm.
instruments, they could be trading other instruments as well. So what happens there is that this feature basically, the secure exit. Now, if we can have the screen, I think that will be good
Sure.
to have. So what happens here in secure exit is that, for example, I'm a trader. Okay, now I say that, okay, I have got two three positions, I have to look at my positions all the time. So if one is in profit, I book up, I square off that trade. Loss, I keep on holding. In this, what happens is, in secure exit, what happens is that you can define for yourself what is the maximum profit that you want, what is the maximum gain that you want. So
Okay.
maximum profit and maximum loss you can define for your overall position. So
Hmm.
effectively, suppose there is a trader who says, okay, I'll take a, if I make 1500 rupees profit, my trades should get all executed. if if I'm making a 1,000 rupees loss or a 750 rupees loss at any given point of time,
Hmm.
all my trades get executed, squared off. So this is
Hmm.
what happens. So this basically is a very good feature to have for traders, because I remember I meet many traders, all types of traders. So there was a very interesting guy I met who's been trading options for years. So I asked him, and anyone who's been trading options for years, he definitely knows what he's doing. Because unfortunately, what happens is that many times people really don't know what they are doing, but still they are very active in the market. That's not a good place to be.
Right.
So having some knowledge, having some, so I really appreciate all the viewers who are here or who will be watching it live or maybe watching it later on to really understand. Because if you gain an edge in the market, you stand a better chance
Hmm.
compared to the rest. And to gain an edge, you have to gain knowledge and experience at the same time, having the mental mindset, which is very important, where risk management can help you. Because you might have the best trading system in the world, you might have the best analysts in the world, but if you don't have a risk
Hmm.
management in place, nothing is going to work. God is also not going to save you. God might save a person once, but God is not going to come every time to save a person. And to trade in the markets on the hope of God is never a good idea. So
Right.
coming to this secure exit basically gives you that opportunity to define at a portfolio level as to what is the maximum loss you want to take, what's the maximum profit you want to take, and once that level is reached, your trades are all squared off. So this is a very good feature. It helps the traders, active traders. Also, it helps you protect your capital, because suppose, for example, suppose someone has got a 5 lakh or a 1 lakh capital, then and
Hmm.
he's an active trader. So in that case, if you're trading in a single day, you shouldn't actually risking more than 2% of your capital. So 2,000, 2,500 is what you should risk on your total 1 lakh. Many people, they have
Hmm.
no concept of risk. They'll risk 50,000 on a particular on few trades, and if 50,000 is
Yeah.
wiped out, then 1 lakh becomes 50,000 now. So they have lost 50%, but to make that 50%, they have to generate 100% return, because your 1 lakh becomes
Hmm.
50,000. Now for 50,000 to become 1 lakh, you have to generate 100% return. So somewhere or the other, it becomes very important. Risk management plays a very crucial role. This is an excellent feature to have. I would definitely recommend traders to look at. Those who can go ahead and want to set stop loss for each and every trade, that also is a good way. In that, the advantage one advantage is that you can define your stop losses based on technicals. You can use, that's one way. If but if you really are looking at from a very short term perspective, this can be a very good method to look at, and this would be highly appreciated by most traders, because this is a technique, a practice which is followed by many professionals as well.
Hmm.
Because just to take it one step further, all these fund managers, all these hedge funds which are there, they also have a limit as to how much loss they can take in a month, how much loss they
Right.
can take in a quarter. So if they're and all these traders who are at many different trading firms, they have a risk
Hmm.
capital, that this is the maximum risk you can take in a month. If that percentage is breached, that trader will not be allowed to trade for the next 3 months or whatever. So this is one
Right.
very good strategy. I would definitely recommend everyone to explore it. It can definitely help you stay calm in a market which is at times very chaotic and very fearful, and same time at many times it's very I would say exciting and rewarding as well.
Right. So now let's talk about traders and risk a little bit more. How do you think that traders can fine-tune their risk strategies? Because a lot of traders do have management strategies in their portfolios, but not everyone is using it efficiently. So, how do you think they can do it more effectively,
So there are two
especially when
things
we talk about uncertain markets?
So there are two things that traders can do. One is that you need to define what is the risk that, and if you're a short-term trader, you need to define what is the risk that you're willing to take on a particular trade, and what is the
Hmm.
maximum risk that you want to take in a month. So, for example, if I
Okay.
have a capital of say 100, I will say, okay, on a particular trade, I will take 2% risk, and in a month, if I make a 10% loss, I will stop my trading. So effectively, it
Hmm.
means that 5 trades will go wrong one by one. Then maybe I will stop. I will analyze. So you have to analyze and evaluate where you're going wrong. Maybe 5 trades also is not a good number. Maybe you can take it to 10 trades. So 20%, the stop loss, your capital gets wiped out, then you stop your trading. Because
Hmm.
why I'm saying I've increased that from 10% to 20%, because a very successful trader in the world who goes by the name of Bruce Kovner is also a multi-billionaire. I think currently he would be worth, a man worth $3-4 billion. Very successful trader. In one of his interviews,
Hmm.
he was asked as to how do you manage your losses, how do you manage your risk. So he said that and what's the maximum number of stop losses that have been triggered for you. So he said the
Hmm.
maximum number of consecutive stop losses, that is one after the other stop losses, that have got triggered for me is 18.
Okay.
So his 18 trades, one by one, went into, all these 18 trades went into a loss, but still he was able to survive in the markets because of his risk management. So
Hmm.
he said, because he had a sizable capital, he said, I don't risk more than 0.5% on a particular trade.
Hmm.
So or maybe if it's a very some other conditions are maybe 1%. So even if 18
Right.
trades or 20 trades go wrong, that is only 20% of your capital. Still you have 80%
Hmm.
of your capital remaining. But unfortunately, what happens is that majority of the traders, not only in India, I would say globally, that's the same phenomenon. They miss this most important piece, that you have to somewhere be prepared. It's not that you shouldn't be optimistic and should not expect that your trade should go right, but you have to be realistic that the trade can
Right.
go wrong also. So if the trade goes wrong, what do I do? Do I pray to God, or do I actually have my risk stop loss risk management in place, and I will pull the trigger when the trigger requires to be pulled? And that can only happen when you have a strategy before you enter the trade. So these
Right.
two things are very important, which I said. You define the risk on a particular trade, and you define what is the maximum loss that you're willing to look at in a month. And that should not be seen.
Okay.
So I would say don't go beyond 20% in a month max. On the higher side, don't raise more than 2% of your capital on a particular trade. And one important thing is, suppose you have a capital of 1 lakh, and your 1
Hmm.
lakh becomes 1,50,000. Okay. What you can do in that case, on your 1 lakh capital, you take 2% risk. But on your 50,000 profit, you can take 5% risk. So in
Hmm.
that case, you are getting the advantage of leverage also. So it's not effective really the 1,50,000. It is roughly around 2 lakh plus capital. So that is
Yeah.
the second thing which traders can definitely look at, that they can risk a higher percentage on their profit, but on the capital, as I said, it's like scuba diving. It's your oxygen supply, it's your capital. You have to protect, and no one else is going to come and protect you or protect you in the market. And the market, as we all know, is a very brutal place. As we are seeing, the market is neither your friend, neither the market is your enemy. It is what we make the market to be. If we want the market to be our friend, we can make the market our friend. Making the market an enemy is never a good idea, because everyone else is out there against you. So rather go with the flow, go with the trend, use some technical indicators, have some understanding, and also risk management. I would say that is the paramount. As I started with the first line, what separates winners from losers is risk management. So I'll stop with that.
All right. So before we move to the questions from the audience, one last thing I want to discuss with you is about the myths that are out there in the market. What is the biggest myth you've come across when we talk about risk management in trading?
Some of the myths are, one is that uh, मेरा भाव आएगा. Many people believe that my price will come, so I will not exit the trade if the trade starts going in a loss. So what happens there? Now, if you look at the example of Cochin Shipyard,
Mm,
it has corrected by almost 60%, from almost 3,000 levels to sub 1,200 levels, corrected by almost 60%. Again, it will come to 3,000, but you never know when. Another
mm,
example I want to give you is Tata Motors. Tata Motors in 2017-18, if I'm not wrong, it had reached almost 600 levels. 600.
mm.
From there, it corrected to 60. COVID times. From
Yeah,
there, it rallied to 600, then 1,200. Again, it has come off significantly. तो भाव तो आपका आएगा, पर कितना टाइम लगेगा? How much time will it take?
yeah.
So those who want to understand, this is a very important myth, that oh, my price will come, I will not exit in a loss. You should never think that way. Only, as I said, that's one option. If you are a long-term investor, you're investing in quality stocks, and you are having a
Hmm.
stock SIP mode, then only, and there also you have to have a lot of patience and at least 3 to 5 years or maybe 5 to 10 years horizon. And whenever there is a major significant correction, you add on to your positions and hold, but only in quality stocks. Because what happens is that many, if you're investing in stocks which are in controversy, which are in debt,
Hmm.
which are not doing well, and because of some news you have invested in that, that's never a good idea. So what you should think, ask yourself two questions: will this company be there after 10 years, 20 years? One, how's the business model of the company? And secondly, how's the management of the company, whether it's forward looking, whether they adapt technology or not. Because companies which are not adapting technology, they'll get absolute. Now, for example, EV, electric vehicles, the way
Yeah.
electric vehicles are taking over, every automobile industry or company will have to change themselves. Or the case,
Hmm.
take the case of Starlink, which Elon Musk is planning to bring to India. That could revolutionize the entire telecom sector. Everything could go for a toss for the existing players. So
Hmm.
there would be disruptions in the industry. But like for example, FMCGs, there, pharma is there. These are sectors which will always be there. We are going to eat, we are going to consume, we are going to fall ill, we are going to use medicines, hospitality, travel, tourism. So if you can identify stocks which are there, doing good, have a long-term
Hmm.
potential, and you look at them, makes sense. But otherwise, myths is mera bhav aayega, so I'll keep on holding. That's never a good idea, because you'll take so much of pain, you'll take so much of psychological stress if the price corrects significantly. So that's the reason the best of the best traders and investors say that have some rules, even simpler rules, but have some rules for your trading. So that's one myth. Second is, as I said, I will average my losing trade. That is a not good thing to do at all. I never suggest people to add to their losing trade in trading. If you are into trading, never do that. If you are investing, still that is an option. If you are looking at quality stocks, otherwise that's not something I would recommend. तो पता ना कि average करते हैं, loss और average करते हैं, मेरा भाव आ जाएगा. That can protect you at times. कभी कभी आपका भाव आ जाएगा, but वो नहीं आएगा. और जैसे कोचिन शिपयार्ड, the way it has corrected, if it starts
Yeah.
correcting that way, where you will exit. So these are
Hmm.
certain things. And third myth is कि ज़्यादा leverage लेने से ज़्यादा फायदा है. Don't get into that. Leverage is something which you can make a killing or you can get killed if you don't know how to manage the leverage. It's like a gun. I'll just explain with an example. Suppose there is a gun. A gun in the hand of a soldier will protect the country. A gun
Hmm.
in the hand of a criminal will destroy. And a gun in a hand of a child who doesn't know anything, what will happen? It's a very dangerous thing. So leverage is very good if you know how to manage it. But if you don't
Right.
understand leverage and you don't understand the risk, pros and cons, it can be detrimental to your health, financial health I'm talking about.
Hmm.
So leverage ज़्यादा अच्छा है, वो तब अच्छा है यदि आप उसको use करना जानते हैं. If you can understand how to use it, it's very good. It's like you can, as I said, you can, the gun, you can protect your country. So if you can use the leverage in the
Hmm.
right way, you can manage risk. It's a good thing to have. But if you don't understand leverage, if you don't understand about risk, then it can be something which can be quite dangerous.
Absolutely. So now it's time to take some queries from the audience. We have a lot of queries. We have individual stock related queries as well, but let's start with the topic related questions only. So whichever question you find you don't want to take, just let me know. But I'm going to start with the first one, which is about implied volatility. Sanjay is asking, "Hi sir, what is implied volatility and how is it calculated?"
Yeah. So basically, what happens is that there are two types of volatility. One is your historical volatility, and the other is your implied volatility. So it's called
Hmm.
IV. So basically, if you look at the India VIX is a very good indicator. So you will find that that keeps on changing based on certain calculations on the options pricing it is based. So when we see that the IV, now IV implied volatility, you'll find that in times of extreme movement, in times of events. So you'll find
Hmm.
that if there is an RBI event, if you find ahead of the budget, if you find there's a major announcement from the US or some major country, you'll find that IV in that is, or ahead of stock earnings. So quarterly earnings, all those stocks which are in FNO, you'll find that their IV increases. Why? Because markets are expecting increased volatility in that particular stock. So
Hmm.
automatically you'll find that the option prices increase for those particular companies for because markets are expecting it to move either ways. So that gives you a clue. Implied volatility gives you a clue that there's likely to go into, there's likely to be a increased volatility. And where the IV is less, that means the markets are not very much, or the stock isn't going anywhere. It's more of a consolidation. So if you're into
Hmm.
option buying, and you can look at or identify or have ways wherein you can identify that there is an opportunity here, and before the IV really starts expanding, you can get into the buying, you can make a lot of money. But if the
Hmm.
IV has expanded and then you get into option buying, because IV collapses also very quick, so in that case the premium will fall. Even if the stock is moving in your direction, you'll find that why is the option premium not increasing, because the IV has
Hmm.
collapsed, so it will not be that increase. So hope that answers your query. Yeah, what we can do is, in case there are more queries, we can take few queries
Hmm.
definitely, but in case there are more queries, you can also mail it to me. I can answer them as well. So if that is the case, we can do that as well.
Okay.
Yeah, so I can share
All
my
right.
email
All
ID,
right.
and they can write to me as well.
Sure, sure, sure. So, we'll just take one or two more and then we can close our session. Lalit is asking, is it a good idea to apply stop loss for the stocks that I have in my portfolio for a long-term investment?
That's a very good question, Lalit ji. So, see, if you are, as I said, from a long-term perspective,
Mm,
if you're looking at stocks, then you definitely have to focus on quality stocks. Never compromise on that one. Secondly, if you long term again means at least 3 to 5 years, because why I'm saying that, you have to have both a bull phase and and you can also see, like what we are seeing right now is a correction from almost 26,300 levels. Nifty's come down by almost 4,000 points roughly. So the point what I'm trying to tell you is that it's just like day and night. You have day, again you have night, again you have day. So like that, you have
mm,
cycles in the market. So if you are from a long-term perspective, you can hold on to your positions, but at the same time, you should look at averaging those quality names, and at the same time, you have to be aware as to what is changing in the company. If there is a major change in the company in terms of the company losing its leadership position, or the company, or some competition has disruption has happened in the industry, and
mm,
the company is not able to manage or maintain with the trend, then that could spell disaster for the company. So these are, so
right.
some major, if there is some major change, and believe me, you get all this information at a decent time. It's not that when everything has happened after the storm only you come to know. It's not that.
Mm,
All that. So if you, whatever your portfolio is, you should keep some track of the news events in that stocks. That will be helpful. Stop loss
mm,
also you can have, but stop loss you should. My best advice to those who are into long term investing, that if you're looking at long term investing, your stop loss has to be at a very very appropriate place, and you'll have to have large stop losses, and your entry will also have to be then important. Just because you have taken a position and then you want to have a stop loss is never a good idea. Stop losses either should be before you are taking a trade, because that time you are not tied to your position, nor you are not emotionally attached to your position. Because once you buy
mm,
something and then you decide where to put a stop loss is never a good idea. But still, I would suggest that look at the stocks. If there are quality names, you can hold them. If they are not, any controversy or something, get out of them. You can average your trades, but again from a long term perspective.
all
Thank you.
right. So, last question I'm picking, we'll quickly take it. You mentioned about averaging. So the next question is about averaging only. Dharmendra is asking at what price I should do an average.
That's a so if you are looking at from a long term perspective, I would say any correction which is 5% to 10% correction in a stock, and if the stock is a quality name, you can look. Other thing you can do, I would suggest, that's an even better idea, which I look at. I look at the long term chart. So I look at a weekly chart, I look at a monthly chart, and I see where the stock is having major support zone, where the stock is having major resistance zone, and that can help you significantly as to where you can add on to your positions. So that is something which you should definitely look at. Traders, I would not recommend averaging. You can you can be it can work in your favor, it can work against you, but when it works against you, it can hit terribly hard. That's the reason in trading I wouldn't
Hmm.
recommend averaging. In investing, still you can average. then you can look at a 5%, 10% correction. If you want to be even more better place, then look at the weekly and monthly charts. You can draw horizontal lines where major supports are, where major resistances are. That gives you a very different perspective of the stock as well. So that's something we can definitely look at.
All right. So I think we are done with the queries for now. For the queries that we did not take, we'll try to take it in our next session probably. Well, this marks the end of our session. Thank you so much, Mr. Amar, for taking out time and explaining all about risk in today's session. Thank you so much. And thank you everyone for joining us today.
Thank you, Neha, for having me on the show, and I wish all of yours brighter days ahead.
Thank you so much. Thank you, everyone.